Hello and welcome back to the channel. My name's Neil Kane. Today I'm going to be talking and walking through some of the important market updates that we've seen play out here over February. February has been a pretty volatile month to start off with. We've seen a big reaction in terms of risk assets to the Federal Reserve Chair announcement, which is Kevin Walsh. We've seen the reaction to that change in policy be pretty swift, specifically in cryptocurrency, where we've seen a retracement of about 50% from the highs that we saw just after the election. So if you look here, the graph that we're showing here is actually the major crypto exchange, which is Bitcoin. Bitcoin now trades at 70,000 a coin. It just was trading at 125 a coin late last year. So major reversal, almost a 50% reversal that we've seen there, and a pivoting into defensive assets. So that is a major change that we saw. And crypto often acts as a canary in the coal mine, with crypto leading some of the other areas of the market that are pro growth, let's say tech, software, AI. Generally, if we see a 50% crash of crypto, we're going to see some volatility in these other areas. We've seen some of that begin, but we don't think that we're through the woods yet on those areas of the market reacting to some of the risk off appetite that we're seeing. A lot of this is due to highly leveraged bets in these risk, high beta areas of the market. And when liquidity evaporates, meaning those leverage bets have to be liquidated, we see massive price movements. And again, 50% off of those highs in crypto tells us there's something going on in the market. And that's really kind of a risk off sentiment that we're seeing play out here. Now, when it comes to what we've promoted that folks need to be fundamentals based, right? We are promoting that folks look at areas of the market that have high cash flow, that are credit worthy, right? Because if we now look at what markets are pricing in that the Federal Reserve Chairman may not be as accommodative as previous Federal Reserve regimes have been, meaning that this particular Federal Reserve Chairman has said statements that he does not believe that we should have stepped in and done the asset purchases that we did after COVID or after the great financial crisis, or at least extended those as long as we did. He does not believe that we should have kept rates artificially low for as long as we did. And we created a lot more issues in doing that. So that means that we may not have the safety net that the Federal Reserve has been over the last couple decades, which is really benefited growth assets. Treasury yields may also react to that. We might see a tick up in Treasury yields, which also has a negative effect on growth assets. But what we believe is that that will normalize the market. So if we do see any sort of correction on growth assets, the benefactor of that is going to largely be in the areas that we have invested in over the last 12 to 18 month period, which is the value oriented areas, the stocks that generate cash flow and revenue now, that have more stable and more corrected PE ratio pricing, as opposed to some of these high flyers in the market. We also think that international investments may continue to benefit from this movement. In 2025, we called that international would most likely benefit from the changes that were going on in the high P ratios. We were correct in that. We believe that that will continue into 2026. We also like the role of fixed income in portfolios as a defensive asset that will provide liquidity and stability during downturns so that you can take advantage of those as opposed to being totally in the stock market. We also are looking at other areas to risk manage, such as investments that have some buffers and safety levers in terms of notes that we are utilizing in customers' accounts. So these are just some of the areas that we're positioning in. As far as you are concerned, in terms of allocating your own TSP and some of other outside accounts that you may manage, we are positioning ourselves for a 10 to 15% pullback in the markets. And we think that that may start sooner than later. We believe that having that long term strategic allocation is still important, but we want to be nimble in terms of being able to take advantage of any pullbacks, right? When we rebalance on a quarterly basis, that helps. And we want to make sure that clients that are managing their own stuff avoid any behavioral pitfalls, right? Don't just react to any sort of short-term weakness. Make sure you have a strategy going in, and make sure you know what you're doing. Don't get ahead of your skis. Don't be over your risk tolerance right now. This is not a time to do so. When we see some of these riskier segments of the market reacting this way, it's a time to be defensive. So hope this message lands well, and that you stay invested, but stay nimble and stay unemotional. Thank you.